Just want to thank my esteemed panelists here, starting on my left with Andrea Balkan from Brookfield, followed by Michael May, my colleague from Silverstein Capital Partners, Tom Rugg from Deutsche Bank, and then Katie Keenan from Blackstone, and Scott Weiner from Apollo, and then Chris Tokarski from ACORE. Great group of people. This seems to be a year of first half, second half. And I know many of you did a lot of your, the bulk of your business the first half, and the second half sort of dropped off. But I'm just curious, maybe starting with you, since you are immediately on my left, Andrea, how much of a, two-edged sword was 2022?
Yeah, it wasn't that dramatic in the terms of the volume, but what it was a pivot in what we were doing. So, we probably did 1.5 times in the first half what we did in the second half. But in the first half, what we did was our standard business, originating whole loans, selling the seniors, retaining them as. In the second half, we did a lot more buying CMBS, joint originating with senior lenders, or buying off somebody else's balance sheet. So the dollar amount didn't change, but the profile of what we were doing changed a lot.
Michael, our business is more chunkier, so probably not as big a dramatic effect. But
we're going to be, we're going to be slightly more in the second half than the first half. But to your point, we do more elephant hunting. We'll do $300 million, $500 million loans that we hold on our balance sheet. The difference in what I see between the first half and the second half is really the senior loan market. And so what we've done more is shifting into whole loans versus doing mezzanine loans. So we haven't really had a dramatic increase in rates, but we've just improved kind of the credit and where our attachment points are as the senior market has become a little choppier.
Deutsche Bank.
And then I'll jump in here, Marty. Yeah, I think, so Deutsche Bank, a large investment bank, we're in the business of writing large deals for clients and then either holding a tranche of that deal on our balance sheet and syndicating down or arranging large CMBS deals. So 2021 versus 2022 were distinctly different. 2021 was representative of huge volumes, record volumes for the commercial real estate industry. Deutsche Bank was a huge participant in that, both in balance sheet lending, special situations lending, as well as CMBS lending. 2022 started where 2021 had left off, which was a lot of volume. And a little bit what you saw in the markets was you saw the capital markets, the CMBS markets, and the ABS markets start to get choppy really in January and February. That led borrowers to turn to the traditional bank market. And so you saw banks, Deutsche Bank included, and all of our peer banks, commercial banks and investment banks, really step up and try to fill that void. And kind of where things went from there is in the first half of the year, the banks really kind of got full in terms of reaching their caps and their limits. And you continued to see the agencies lend on housing and multifamily, so you saw that kind of continue through the year. But you saw banks and life insurance companies, because the capital markets had become so choppy, borrowing costs had widened pretty dramatically in a short period of time, that you then saw the traditional lenders, banks and life insurance companies really kind of get full, closer to their caps in the first half of the year. And so we saw a lot of volume the first half of this year. We saw a little bit more diminished volumes where we were much more selective in the second half.
Great. Blackstone?
Yeah, I think without echoing what others have said, I think a different perspective I might bring. I think volumes, I agree. I think one of the interesting things we're seeing now in the second half is more of a barbelled opportunity set. So whereas the beginning of the first half of the year was much more sort of the regular way flow business, plenty of opportunities to do, we pulled back from that, around the end of the first quarter. Now what we're seeing really falls into two categories. We have lower leverage deals, great for our insurance capital. A lot of regular way borrowers who historically might have borrowed 65, 70, even 75% are looking at their deals and saying, we'd really rather borrow 50 or 55%. Lower cost, better to make debt service coverage work, works well for an insurance bucket. And then on the other side, a lot more opportunistic, types of investments, whether it's securities investment, CMBS or other types of securities where you can buy at a significant discount and create a really interesting return, or more on the mezz side or more creative deal structures, whether, could be a senior loan, but I would call it a more opportunistic loan, or something that looks a little bit different than what we're typically used to, and where borrowers are willing to think about a more creative structure because it's really the only way to put a deal together. So definitely a more diverse lending environment in terms of the types of opportunities now.
Scott?
Look, I would say for us, kind of echoing what Katie said, I mean, while I'm on the alternative panel, the largest source of capital that I manage is actually for an insurance company, which is really an unlevered lender, which in today's market is a great opportunity. In the first half, maybe the first quarter of the year, let's say everyone was firing on all cylinders. You had alternative lenders, mortgage REITs, everyone, levered lenders, fixed rate, everything was on fire. Fast forward to the second half of the year, and really leverage on leverage is gone, given what's going on in the CRE CLO market and what's going on with the banks. So where we're seeing a lot of opportunities on those A notes. And what's interesting, despite people's concerns around credit and what's going on with cap rates, when we're looking at a deal, there's 6 to 12 people all interested in the credit, the junior part of the capital structure, and there's only a handful of people that are interested in the A note, which works well for our capital. We can put out larger checks and be more safe. We don't need the double-digit return. So I would say that's an interesting phenomenon, and that's in construction, that's in hotel. I would say the other interesting phenomenon is just the overall interest rates and what that means for debt service coverage. So we were doing fixed rate loans early in the year, 3%, 3.5%. Now that's 6%. So one is just a shock, especially for the younger people on the team who haven't really seen interest rates that high, but actually having to explain to them that debt service coverage is actually something they need to make sure we have, which for a long time, hopefully you guys are covering that in school, but for so long, all everyone ever focused on was debt yield because debt service coverage is 3, 4, 5 times. Now we literally had a teach-in to explain debt service coverage and looking at it on an amortizing constant, and literally had someone say, well, am I looking for 1.0? And had to explain 1.0 really means there's no room for error. If the cash flow goes down a little bit, you're not covering. So I would say that's really a new phenomenon, and really loans being constrained by that debt service coverage. So I would say, there's still, I'm sure we'll talk about cap rates later, but we were still seeing some multifamily acquisitions at still very low cap rates. But when you kind of put on today's interest rates and amortizing constant, like you're solving for a very low leverage, which one would interpret as meaning maybe that cap rate was a little too low.
Great. Chris?
I mean, we were doing gangbusters through June. We have about 10 deals in the pipeline now. But I think we're probably going to end the year about 80% of the volume of what we did last year. So we're still semi-active, but nowhere near. The first 6 months was gangbusters.
So did any of you guys feel like at the end of the first quarter you were going to have your best year ever?
I mean, I think from our perspective, we looked across. I mean, I think one of the things we do well at Blackstone is look at all the information we have, not just in the real estate business, but all the way across, whether it's credit or our private equity business and things. And I think, look, we all saw the CLO market, what was happening the end of last year, the beginning of this year. So I think the cracks were apparent, at least, we felt they were at that point. So, sort of came into it assuming it would be a different type of year. But, the first quarter volumes always really more reflect the last part of the previous year. But I think probably most of us felt a little different at that point.
Yeah, I think same for Deutsche Bank. We just given our capital markets platform, we had begun to see those cracks. The Fed tone had started to shift in, as early as December, and so we really came into the year, on the one hand, optimistic that maybe we could, credit spreads were widening. That might lead to a little better yield environment than what we'd had the past, call it 10 years. But on the other hand, very cautious around just credit and the capital markets. We, to your point, it became very visible and apparent, sort of early in the first quarter that the capital markets were starting to shift.
But Marty, also I think it depends on how you define best year, right? Yeah. Obviously, if you look at volume, that's one thing, but for all of us who have floating rate loans, those loans were making a hell of a lot more money than we thought they were going to make this year, which also kind of it fixes a lot of other issues, if you will, if you're kind of thinking of it as a balance sheet lending platform.
Scott, I think that's a really good point, because as we look at and other people look at our AUM, our origination volume is less than it might have been a year ago, but the repayments are way, way less. Yeah. So the amount of assets you're still managing are the same or more despite less origination volume.
And making more money.
Yeah.
Yeah, it is the best year ever. I mean, it really is. If you're an AUM lender, it's the best year ever until the borrowers stop paying, and then it's going to...
Yeah, there's that.
Then your AUM shifts to owning real estate, and you just become an owner of real estate.
But you bought it really cheap, so it'll be okay.
right? I mean, there's this balance, especially in the construction side, between making more money, which just means that the investor's making less money, and you tend to get out of balance on interest, right? And so interest you can accrue, you can let it grow, and at some point though, you're starting to push into the equity and their ability to refinance on takeout. So it's great along the way. Feels really, really good, right? Until maybe at the end, it's not going to be quite as exciting.
Well, putting my borrower hat on for a second, I really don't like these floors you guys put on. They tend to become market. But so as interest rates rise, the spreads tend to tighten a bit. You want to talk about that? What do you see in the market?
I'll start. I mean, yes, I would say if you go back to the GFC times when we had interest rates similar to this, I think, and Tom will correct me, but I think AAAs were 25, 30. I mean, right, you saw much tighter spreads and people were solving for an all-in rate. You know, I would say, I'll blame Katie's colleagues at Blackstone for doing this to us. I would say Blackstone did a masterful job of using the capital markets, CMBS, to enable them to buy very, very large transactions. And so real estate finance today is highly correlated with CMBS, which is then correlated with the CLO and corporate market, where I would say a decade ago, the guy at Teachers or MetLife, no offense if you're here, you know, was given an allocation, do this interest rate if you were a bank, right? You didn't have a Bloomberg, this is what you were doing, you had your allocation from the beginning of the year to the end of the year. Now, there's very few people that don't have a Bloomberg. Everyone is looking what's going on in other markets. And so we are, you know, my view is until the corporate markets fix themselves, high grade, high yield, you're not going to see real estate spreads, because all of us are allocations or insurance companies or other things or alternatives. So people are looking, oh, if I can go buy a AAA CLO here, why would I go do a real estate loan? So I think we did, I don't want to say we did it to ourselves, but like the whole capital markets and making real estate such a large, you know, visible market, you know, we're just tied now with everything else.
I think we can blame Tom for that more so than others.
I was waiting for this.
But I think the other interesting dynamic when we think about spreads is, you know, the absolute level of base rates is important, but I think what's really happening right now is the rate of change. And so, you know, when you think about how you price a loan today, particularly if you're lending on the fixed rate side, if you think your base rate is going to be 50 basis points higher tomorrow, you need to think about that in your spread, right? Quoting a spread today and then all of a sudden locking rate and then having it be worth less 3 months from now because rates have moved so much, that's not a setup that anyone wants to sign up for. And it's happening on the same level, you know, to some extent on the floating rate side, because even though the base rate goes up, it also affects the credit profile. So I think that people in some ways have widened their spreads to compensate for the risk profile of rates continuing to rise. And as we see, you know, as the Fed has signaled, or hopefully sort of the rate hikes level off or even stop, you know, I think that is to some degree an impetus for spreads to stabilize or perhaps ultimately contract over the long term, because you'll see it in less risk profile and the base rates increasing. And you'll also see it in fixed rate fund flows, which is a big dynamic that I think impacts the securitization market and how everything gets priced. When rates keep going up, people's bond portfolios are worth less, they pull money out of the market, and that just creates a big technical in terms of fund flows that I think will you know, moderate a bit as rates stabilize.
And the other component to that is the banks are not in the senior loan market right now. So, you know, like we would originate a whole loan and sell a senior. Well, when I can't sell it to a bank, then you're selling it to an insurance company, and the insurance companies are, you know, looking at relative value and saying, hey, you know, I can do a high yield and earn 11%, you know, and have a single A rating. You know, why do I want to buy, you know, a first mortgage in real estate? So that's preventing the compression that we've seen in almost every other cycle.
Yeah, I think to both of your, you know, Andrea and Scott's points, I think the mezz market, I don't think has really moved that much in terms of pricing. It might have, you know, compressed a little in terms of credit, but not a ton. But the senior loan market is, you know, disappeared. And so what you used to be able to get, you know, highly competitive 55% quote at 300 over, it's now a 40% quote at 450 or 500 over in a lot of asset classes. And so that gets filled in with mezzanine. So that's better for me because I have a better attachment point, but it means that the overall cost is a lot higher. And then when you tack on the fact that base rates are, you know, up dramatically, it makes the cost of borrowing significantly higher.
Real estate's in the newspaper every day. right? And I think people are very concerned that, the headwinds are gone. There are headwinds, no longer tailwinds, and we're not even in a recession yet, and values are going down. So I also think people are pricing in a credit or risk premium for concerns around values going down.
And are any of you guys pressured by regulators? This is supposed to be alternative finance. So Deutsche Bank, you have regulators breathing down your necks that create higher spreads for you?
Yeah, I think, and Miriam mentioned this, I think, on the morning panel, but, the Fed stress tests are important for real estate, and this will dictate how much capital, has to be held against your real estate portfolio. More capital that gets held against real estate means that capital may get shifted elsewhere in the bank, but, we'll see how the Fed stress tests go, in 2023. But so long as, those ratios, remain healthy, and the banks do well, I would expect that the banks will continue to be active. But going back to my first point, banks operate within a risk limit set for a business. That risk limit is approved by the board. It's approved by the bank's regulators. So whether you're a bank that has $15 billion of maximum exposure to commercial real estate, or you're a larger commercial bank, you have 30, 35 billion, you're still operating within a risk limit. And just going back to the dynamics of how this year played out, where borrowers really leaned on the traditional bank market the first half of the year, that's where you're really seeing the pressure, where banks are up against those caps. You're not seeing refinancings occur, just given the higher interest rate environment that we're in right now. So you're not getting that capital back that you can then redeploy into new loans. So, we are, to your first point, Marty, what's particularly painful for borrowers has been not just the soaring interest rates, but the widening of credit spreads. And I think that everyone on this panel, hit it directly, which is, the absence of a really well-functioning A-note market or a repo market, just really shows how tightly integrated, alternative lenders, particularly mortgage REITs and the credit funds, debt funds, are with their banks. They really do rely, on their banks for funding to kind of support that business. So, I do think it's just about, solving, the inflation and interest rate environment that we're in right now, and that may lead, once we sort of see the Fed hit that terminal rate. So long as the recession is moderate, I think that could provide a backdrop then where you start seeing some more stability in financing rates, some transactions actually occurring, and then once you start to see some repayments, the banks are in a much better position then to continue to lend and do what they do.
No one else is regulated, right? Blackstone.
Well, regulated different ways. Well, yes.
But not
Public company
Insurance
SEC
regulators,
regulation is
SEC, but
okay.
real.
And so you've all touched on it. Other than selling senior loans or being in the CLO market, are there other ways that you finance your loan business?
Maybe I'll start. I think that developing a diversified set of financing sources is super critical, and I think it's something that we've put a lot of effort into. I would say one of the interesting dynamics we're seeing is, all banks are not equal, right? We have definitely a very different tone coming out of some of the Asian banks, out of some of the European banks, insurance companies, other sources of capital. I think that, whether it's less exposure to the securitized market or, just a different regulatory regime, there's a big difference there. And I think the other thing we have done a lot of, we've raised over $1 billion in the corporate capital markets in the last year between the term loan market and the convert market. So, I think the markets are correlated, but they're not all having the same dynamics at the same time. And I think it really rewards those who are nimble and creative in terms of where to access the capital and also have the relationships, because it's hard to make the first call and create a relationship in this environment. But I do think it is also about matching up the opportunities with where folks want to lend money. The currency dynamic is really interesting right now. Obviously, the U.S. currency has appreciated a lot. You would think that would reduce the desire of some of the foreign banks to come into the U.S., but there's a reason for that. It's the perceived stability, the perceived growth profile of the U.S. economy relative to other world economies. And so we're actually seeing that is resulting in folks wanting to allocate more dollars in some cases. So, I think that it's not as monolithic as potentially it might seem. And, I think there are opportunities. It's just we all have to be a little more creative and work a little harder to find that capital.
We've found more liquidity with smaller and regional banks, but it's a lot harder. So your volume slows and they can't do such a big chunky loan. So you're looking at an average loan size that's probably going a little bit smaller. But the other side of it is, we've always been more focused on basis than debt service coverage, which helps because I don't have to look at the debt service coverage. But in this current environment, if you look at the assets that don't have debt service coverage, you actually don't need leverage. With indexes up and spreads up, unlevered returns are great. So you have to be careful and lend carefully and lower the leverage level on those assets because they are riskier. But I think all in all, if you look at the risk-adjusted yields and some of this stuff, doing a lower leverage deal on a property that doesn't have cash flow, but you're very comfortable with the basis, is actually more attractive than putting leverage on, because you don't need to leverage it, and that leverage can come back to bite at times. So taking an asset with no cash flow and no leverage sometimes is more appealing than something that has cash flow, but your leverage could still disappear.
So we've done a bunch of mezz deals with Brookfield and with Apollo, tried to do some with Blackstone, done a lot of deals with Deutsche Bank. The dynamic that Michael set up before where the senior loan market is disappearing, is that creating a bigger opportunity for you guys to sort of go down in the stack and just put out more dollars?
Yes.
Yes. I mean,
we're taking the opposite. I mean, we're doing the A notes, right? So I would say we're almost doing no mezz. We're doing all really senior lending.
So you're just doing the whole stack? One
No,
stop
we're
shop.
just doing the senior.
Just doing the senior
deciding
and making
where we want to be, and the borrower. It's interesting. A lot of the borrowers are choosing not to borrow the incremental cost, right? Because especially if they're a fund, it's well above their promote, right? I mean, it doesn't take much of a spread right now to get that. So we're seeing borrowers who choose not to borrow mezz and happy with an A note, or there are times that folks come to us and say, we're doing a whole loan. Do you guys want to do the A note, or we'll get partnered up with a mezz. But I would say there are less than a handful of people doing A notes in my mind in size right now.
Yeah, I think it's an interesting dynamic because we're seeing that because people are so concerned about the A notes now, they're coming to us and saying, hey, if you can one-stop shop this deal and not have to worry about the senior, it used to be the other way around, right? Then we'll come to you. And so we're seeing lots of opportunities to do maybe lower spreads than we get on the mezzanine, but senior loans where we're just taking the loans down and holding them, and it's a really attractive business for the time being. I mean, the other thing that we're seeing a bunch of, and I've 3 different major brokers, we went down the path of a full deal, and when we got to the end and they put together the cap stack, the borrower said, you know what, we just don't want the money, or we just don't want the mezz money. We're just going to fund it with equity or some other source of capital. Because to your point, it's above the promote and it just doesn't make sense. And so the better projects that are actually out in the market right now, we've seen 3 major projects, called $500 million to $1 billion plus, with major brokers just shelve the project and just move a different direction.
Have you guys started to see any delinquencies?
Also, yes.
In a major way?
I would say, during COVID, office was probably the best performing asset, and for those who didn't really understand and thought all was great, they were idiots, right? Because we all knew it was coming. So I would say, whereas, during COVID, obviously hotels and other properties were more challenging. Hotels, for the most part, with some isolated exceptions, are doing great. I would say it's really the office assets where you're now are starting to see the roll. Owners deciding, do I want to put the capital in? What are the right cap rates? What's the cost of funds, especially if it was floating rate debt? So I would say you're really starting to see the office assets, more the commodity like Class B in markets like New York, Chicago. The stuff you own, Marty, is always going to be great, but those kind of nothing special offices, I think owners and borrowers are starting to make decisions on whether they want to continue to support those assets. And I would say that's where you're starting to have conversations with borrowers.
Yeah, and I think what we're seeing is not so much interest delinquencies. Those haven't happened yet because we've had decent WALT. But what we're seeing is people not meeting their debt yield tests for an extension, or in some cases a loan coming due. And what we're seeing is a little bit of a contradiction because the borrowers are coming in and asking for more term, and in most cases willing to put up money for term. And then the senior lenders are kind of saying, well, we only want to give you a year. And so that's where, we're like playing negotiator in the middle a lot, because you're sitting here saying, well, who's going to put up money for 1 year? Like, you got to give them more term. And that's where the regulators come in, because they're like, we can only give a year.
Yeah.
So we're not so much seeing the distress in the assets yet, although we all know it's coming. What we're seeing is, interim maturities and, a heavy-duty negotiation between borrowers and, senior lenders, frankly.
Yeah, and I think obviously the big question in a lot of folks' mind is where do rates settle out?
Yeah.
Because you're right now with a lot of these deals, you're sort of buying an option because there's a lot of real estate deals that are really tough to pencil if base rates stay at 5% forever, to state the obvious. And so, you have borrowers saying, okay, I believe in my asset, and I agree with Andrea. I mean, the fundamental performance of the assets from a rent perspective, from an NOI perspective, is really pretty good. And, I think for most assets will continue. Obviously, there'll be some challenges with assets that are just not relevant to their markets. But the question is just what folks' view is about where rates end up and how long does it take to get there. And that's sort of the crux of the negotiation about, how much pay down for how long. And we are seeing the option value, the longer the option one can provide, people are willing to put up capital for it. It's just getting to a deal that makes sense for them to invest the new capital, from the terms perspective. And I think that for good relevant assets, high quality assets that should work over the long term, we're certainly willing to provide that flexibility, but it has to come with real additional investment. And I think most folks are understanding of that.
Yeah, I think the CMBS delinquency rate is around 5, just north of 5%. We're seeing a lower rate in our portfolio. We, of course, as a big bank, the most institutional sponsors on, very institutional assets. So it's natural that, you would see a lower delinquency rate there. That's not to say that, the delinquencies are zero. And I think to Katie's point, sort of like, in COVID, the market really, developed a plan for how to, work through maturities and so on. And that was different in a very low interest rate environment. But I agree with Katie in that I think the market is really developing, sort of the process forward with borrowers around exactly what she just described, which is if you need more term in this environment because of where, the shallowness of the financing markets, because of where interest rates are, there may be a trade in there for more term, but it comes with, additional, cash equity, commitment to the asset. And so it does feel like I think the market is sort of forming around that as a strategy. And from what we've seen from our own portfolio, we are seeing, the vast majority of borrowers in those situations, are willing to kind of support the assets. So I think we're seeing, similar to your portfolio, similar behavior.
There seems to be a real aversion with the traditional banks right now, maybe it's because of the regulators, to take back any property from a borrower, and really they seem to be working with the borrowers. And I know none of us up here, none of you guys are really loan to own, but is there an aversion to taking back a property if you need to? Is it at all costs you really want to work with the borrower, or would you really not be reluctant to step in and take back a property?
I like at the same point. I think you'd always rather work with a borrower if they're willing to put capital in. But I think for all of us, a zombie building, especially office, right? If you have an owner of an office property whose basis is off and they're not willing to put capital in, right? And you have a melting ice cube because you have tenants who you need to retain and they don't have the capital, you might as well own it and control it yourself. So I think it really comes to, does that owner bring some sort of operational expertise? Are they willing to put capital into it? What are, in certain markets, the transfer taxes are huge, so maybe it's not worth putting the capital in. What is your capital like? Like if you are a levered lender, it might be easier to not take it back because you can keep the leverage, right? If you take back that property, your leverage is going to go away. So I think there's an analysis for every deal, but I think to be a lender not willing to take back the real estate, it's pretty tough to be a lender because that's really it happens.
That's your remedy.
Those are a lot of metaphors. I see Lois over there writing down melting ice cube and zombie buildings.
I mean, it kind of comes down to, is the deal going to make sense in the long term, right? Under the capital that's there. I think we're seeing borrowers saying we'll put up the interest, but they don't want to put up, they want to pay down the loan. I'm seeing a lot more preferred equity deals in the market where they're trying to raise preferred equity to come and fix the top of the cap stack. And if you look at the forward curve and it can work, that's great. But there's the saying that hope is not a strategy, right? So if they're just sitting around just hoping that the world gets better, or that their asset gets leased, or something else happens, then it's tough not to try to exercise your rights.
And of course, lenders have a whole arsenal of different options here. You can modify and extend, which we've talked about. You can sell your note. You're starting to see, I think, a lot more brokers doing BOVs for different lenders. Perhaps different lenders, whether they're banks or other institutions looking to maybe, prune their portfolios they're thinking about next year. And then, of course, there's foreclosure. I think lenders are keeping all those options, open and available.
But I also think what's interesting is mezz lenders, right, are making choices too, right? We're seeing mezz lenders who are deciding not to protect, right? Whether it's because of the capital they have available in their fund, maybe the size of the existing deal and what they'd have to put into it, right? So you're sometimes seeing mezz lenders walking away from their investments, or the fund's already made plenty of money. Why would I want to put more at risk or go back to my investors and call capital to have to pay down a loan, things like that. So I would say it's both the borrower's behavior and the mezz lender's behavior that aren't always what you would expect it to be.
All right, let's move on to something that's near and dear to my heart. Construction loans. Who's making construction loans these days? Love it. Yeah. See, we're in business, guys. Tell us about the first half versus second half. You're still making construction loans at the same rate you were in the first half?
Rates are out, right? So I think spreads across all assets, you mentioned it earlier, but I think when I look at a multifamily, you're at 100, a construction loan, you're at 150 to 200. Add the index out, 400. Construction loans were the best risk-adjusted yields, and they remain the best risk-adjusted yields. Now you're getting a double-digit IRR on a construction loan, lending 65% to a great guarantor. So we've done more construction over time. We're probably about 20% of our book, and being very choosy. And it's all about the guarantor in our minds, the asset and the guarantors, and it's fantastic. And so, yeah, we continue to do it, and I think for the last 10 years, it's been the best risk-adjusted yield. You just have to wait for the banks not to do it. That's the rule number one. I always say, if you're talking to the bank, forget it. When you're done talking to the banks, come back. Because you're 300 wide of the bank. And the borrower thinks they're going to get that bank rate, and if they can, then go do it. But if you can't, come back, and we'll charge you $600, and it'll be good. We'll have fun.
What is that word? Guarantee?
I would say to Chris's point, I would say early in the year, banks were willing to do construction loans, multi or other stuff, mid to high twos with some recourse. So we didn't compete in that. We were always been more of a 400 over type construction lender, but we were willing to do 65% without recourse. I would say we're doing that same 400, low 400s deal, but now we're doing 45 to 50% leverage. So comparable spreads. One challenge on the construction is you don't put your money out. Right, so that gets to be one of the challenges, right? You want to take advantage of today's market, and you're not necessarily deploying all your capital. So that is one of the challenges. But very busy on construction.
I agree on sort of the leverage and returns point, but the other thing, to state the obvious, I mean, flight to quality from a real estate perspective is just so critical in today's environment. All the demand, no matter what the asset class, is going to concentrate on the best quality assets. That's where the pricing power is. That's how you can stay ahead of inflation. And if you're making a construction loan, by definition, you're sort of having the newest asset in the market. So, I think from a credit perspective, or the types of assets that make sense to invest in, when the range of outcomes is more uncertain, being in the newest, best asset, works well.
Yeah, and I think, our book is probably 10%, construction, ground up development. So pretty limited, but we do have a special situations team which does a great job with that. I think where we're pricing that risk today probably looks a lot more similar to the debt funds. So for us, that's 500-600 over, or even north of that type paper, just given the illiquidity in the market. But to Katie's point, even more important is the credit profile, really trying to bank the best sponsors, the best assets, the best markets. That's really been sort of the key for being able to unlock, the balance sheet, at DB, and I think at a lot of other banks.
Yeah, and I think it kind of, it regulates itself, right? Because the construction projects that are happening now have a reason to happen. And a lot of the projects that kind of didn't pencil just don't work anymore in the higher rate environment. So when you're seeing projects, it's because it's a great market in multi. You're seeing something's leased. There's some reason to do it. It's retail, but it's in Brooklyn and it's in a great street, stuff like that. And whereas kind of the more run-of-the-mill projects just don't work. So either you got somebody who's crazy and you just say no, or the project makes a ton of sense in the stuff we're seeing.
It's a great point. I mean, lest we leave a mistaken impression, I mean, the construction lending in general is way down, right? Because a lot of the projects just don't work, whether it's because, when you build in the actual rate on the construction loan, the economics no longer pencil, or people thought they were going to, build to core to a 4.5% cap rate, and that just doesn't really work when rates are whatever they're going to be. So, I think what we'll see in general is overall construction starts and overall construction lending come way down. But those sort of selective opportunities, whether it's someone who bought the land 20 years ago and so their basis is fantastic, or rents have moved over the term or whatever, the deals that still pencil I think are really attractive, but the sort of aperture, the universe of those deals is a lot smaller.
And I think we all tend to traffic in the larger size deals, and almost by definition, those are going to be the Class A projects.
Yeah.
So, as much as, the world is avoiding office, we've done 2 office construction loans. Both happen to be in the UK, but both are on what are going to be Class A+ buildings with all of the bells and whistles on ESG, which, in Europe, nobody wants to occupy a building unless it is like the top ESG standards. Also, we're seeing it, on condo, multifamily. The biggest challenge we're seeing is in deals where the equity is a partnership and the half of the equity, which has the money, doesn't want to give you the completion and carry guarantee. So that's our biggest challenge, right? You've got your 10% GP who's like, I'll give you a completion and carry guarantee, and that's great, but you got $30 million and it's a $500 million project, and the equity, the money is like, oh, I don't want to give you the completion and carry guarantee, or if I do, I'm going to get better terms from my partner. So that's where we have bid a couple of deals that ultimately we didn't win because we've insisted on real completion guarantees and real carry guarantees.
Let's move on to markets. So obviously, primary markets, how do you feel about secondary markets, and how does some of the markets that start to get overbuilt, like Austin, Denver, Nashville, play into your minds?
I think if there's one thing we've seen in the last couple of years is, the primary, secondary dichotomy is probably not the right dichotomy to be thinking about anymore, because, what we've always been most focused on is dynamic sort of growing markets. And, whether that's a larger city or a smaller city, it's all about the growth. I do think that it's important to be mindful of, is the growth sustainable and how much are you believing the growth, and are you underwriting a 5% CAGR for 5 years or a 10% CAGR for 5 years, because that's never happened in the history of the real estate world, so that's probably not the right underwriting assumption. But, I think that, especially South Florida and some of the other markets, you've got to underwrite reasonably, and maybe that's a little bit of retrenchment, but the cost of living advantages, the dynamism of some of those markets, the demographic shifts, those are all still, I think, very powerful, and it's just about not getting ahead of yourself in terms of, how sustainable are they, where do they really settle out? But we also still like New York, we still like some of the so-called core markets. I think there's a big difference between the dynamics in, New York versus San Francisco versus London, for example. So, I think it really does come down to what are the key economic drivers and what is the growth?
I think I would say almost a wholesale shift out of the big markets into the secondary markets. If you really look at what we funded over the last 12 months, it is Nashville, it is Florida, it is Sunbelt states. Denver, we've done 2 or 3 deals in the suburbs there, and I can't think of the last time we did a deal in New York. It's been a while. In San Francisco, it's been longer. So Chicago, I can't remember the last one we did. So when you think about where we were 5 years ago, we would have only been lending in gateway markets because that's what everyone wanted. And if I look at what we've done over the last year, it's all secondary markets for the most part.
Yeah, I think we look for markets with good state schools, good population growth, good employment growth, low taxes, good government regulation. And I think those are the markets that we're talking about.
Jobs and taxes.
Yeah, exactly. I mean, the hardest thing for us, just because we like to do larger loans, is just finding big enough projects in those markets to be interesting. Like Nashville is a market where, there's, we love the market. We just haven't found, a loan that we could price in the way we want to price and the size that we want to be. But I think that's where I think we're certainly more focused. But there, obviously there continue to be opportunities in all the major markets.
Yeah, and also real estate 101, right? Are there barriers to entry? And are you in below replacement costs?
Right.
So in some of these newer markets, we really have to look and see, are we really in the prime location? And could somebody build next door because, the land has been cheap historically?
Yeah, I think it sounds boring, but I agree with everything that this group said. I mean, we lend in primary and secondary markets. I don't have too much more to add. I think you guys, you nailed it in terms of the shift from I think 2021 was very different than, other kind of peak, volume periods, where normally peak volume periods, you see that in the primary markets. You see that in cities like New York City. New York City was way down in 2021. You saw the Sun Belt, really kind of take off, and that's where, in equity capital and as well as lender capital ended up shifting to. I think it's going to be very interesting, and I can't wait for the Golden Apple panel at 2 o'clock, just because, not to kind of pitch that, but everyone should stay around for that one. But I think that's going to be really interesting. Is this going to be, one of those, recessionary periods where capital comes back into New York because it is, that top market, the most liquid markets? Are there different, factors at play, given how things have played out the last 12 months? I think that's going to be very interesting.
Okay, let's shift to asset classes. So, we're not going to invest in, you're not going to lend on the melting ice cube. Is that what you called it? But what asset classes are you investing in besides, the easy multifamily assets and the down the lane ones? Tell us something interesting that you're working on.
We lent on a JCPenney deal, 5 cross JCPenney's. Ignoring the JCPenney credit, you look through and we lent about $60 a foot for the repositioning of the assets, and the malls were all, 2 of them sales were over $1,000 a foot. The other 3, the sales were $700 a foot. And so when you came in, you looked at it and it's like, JCPenney credit, no way. But when you actually dug in and said, you know what, $60 a foot on this real estate, it can be anything at that level. And so I think a lot of, and that's the way we look at anything that's retail. We're always looking at what's the next use in case the retail doesn't work, and are you at a basis that that works. So anyway, I figured JCPenney would catch ears. So
Retail.
Definitely.
Go retail.
I would say some of the more interesting stuff we're seeing, in advance of your panel, is change of use. So we financed a hotel around the corner on Lexington Avenue that got converted to student housing, which works really well. You guys all know, certainly a shortage of student housing, and a hotel room works great. You have your own bathroom, you can stick 2 beds in there, and then take all the common areas and put a laundry room and stuff, and obviously fix the Wi-Fi. So we've done that. We've also been active in the conversions downtown of office buildings to multifamily. Again, something that kind of got started, after 9/11, which continues. So I find those really interesting. Kind of goes back to its roots of location, real estate, and certainly in a market like New York, you can't make more of Manhattan, and so you kind of got to do with what's there. That conversion, unfortunately, does not work in every market. Wish it would work in Chicago and some of the other markets, but New York just has everything going for it, so it works well here.
Sure. I think that outside of the obvious sort of multifamily industrial, we see pretty interesting dynamics continuing in the data center market. Other things that look like multifamily, sort of low capex, very granular leases, whether it's self-storage or manufactured housing, which is really part of it, but student housing. Life sciences continues to be good, but it continues to be something that you really have to understand the real estate, the market, the tenant demand, and I think that people got a little far afield of that at points in over the last couple of years. But I think fundamentally it comes down to what's resilient or able to capture inflationary growth, right? So you need shorter term leases. Some of the hotel market, I think that we're certainly going to see potentially a little bit of, the last couple of years have been fantastic, but I think that even if you assume things going back to like a 2019 level, which is really how we underwrite as a lender, you continue to see really great opportunities in high barrier to entry assets that can drive that pricing power. So I think, stepping back, it really all comes down to where can you capture inflationary growth that's going to allow you to support higher rates, higher expenses.
Yeah, I think one interesting trade that we got pretty smart on pre-COVID actually was in production studios. Yeah. So financing film studios, of course, content creation, took off in particular, with COVID. So those were just fantastic trades for us. Even though, in today's environment, you've got new supply coming, you've got, a little bit of that content getting pulled back a little bit. At the timing of these trades for us, couldn't have been better in terms of, when we put on that risk. Equity investors that have tons of embedded gains, obviously we feel great about those trades as lenders. And, just not to, industrial may be a little bit boring, but I think another interesting trade, that we've gotten involved with at DB is financing more Class B industrial, but in A locations and markets. And these have been assets that have very, very tight vacancy rates. They trade at cap rates, which are a little bit wider, which gives you, a little bit more cushion against, the type of inflation, higher interest rate environment that we're in right now. And we're seeing, these are bigger trades, so we're actually seeing, very good liquidity, for those types of loans from debt funds, sovereign wealth funds, and so on, even in today's environment. So those are a couple interesting good trades.
Yeah, we did a studio deal at the beginning of this year in Queens, a big deal. And we think that the New York market continues to be dramatically underserved by state-of-the-art studios that are close by, right? You can build in Jersey, but how do you get the talent there? You get a helicopter them in and out, it just becomes a mess, and do you have the people back in? So we think there are certain markets that are great for studios. There are other markets that are much tougher because they're entirely tax-driven. And if the tax goes away and there are no barriers to entry, as you're pointing out, then you're stuck with an industrial building and with a bunch of lighting and grip. So I think that there's definitely some cool stuff to do, and LA is going great in the studio business right now. I think the coolest deal that we're working on is we focus on mixed-use projects in markets with good supply-demand characteristics. And so we're doing a deal right now in Turks and Caicos because what could go wrong with a hotel in the Caribbean? Everyone thinks everyone thinks you're the smartest person in the room, and that deal goes wrong. But it's a market with just incredible supply-demand, and we see that in Florida and some of the other things we've been talking about, some of the other secondary markets. So that's what we're focused on.
And I think I'm going to echo what everybody else has said. We're looking at the same things. We've actually done some, Class B industrial. We've done a lot of self-storage. We've done some studio. We've been doing the kind of financing the office to resi conversion for several years and really like that trade. As I mentioned earlier, we've done some retrofitting of office from, Class B to Class A+, as long as it's in an A location. I guess what you're not hearing all of us say is we're not looking to do a lot of retail, absent, the kind of one-off transactions. And we're all being, more cautious on office. We're looking for the Class A+, like the best of the best, and, not, the B commodity buildings.
So what's happening with the B buildings now? I mean, we're not looking at.
Aren't you guys going to convert them all to resi? That's what we're
are any B buildings going to stay office?
Are any of you guys in the market right now raising money for your debt platforms?
I feel like that's something we're not supposed to. I think that the general opportunity right now for investing as a lender is really attractive. And I think that whether it's from a BXMT perspective, where we're constantly talking to investors, or constantly talking to various parts of the capital structure, I think it's pretty apparent. And actually, one of the most interesting conversations I have is with our borrowers. And what all our borrowers are saying is, I really want to be a lender right now because you're 35 or 40 points lower in leverage and you're making like higher returns than the equity in some cases. And so the investment opportunity is so amazing. But again, it's just the wider range of outcomes, more uncertainty, relative value. I mean, there are so many great investment opportunities everywhere. So I think that every conversation is a relative value conversation, whether it's between equity and debt or private debt and public markets. And we're fortunate in being able to invest all across all of these markets. But it's just a really interesting time.
Yeah, what I would add to that is that there's a lot more reverse inquiry right now from investors who are thinking about debt, or at least trying to understand it and analyze it. And a lot of the pension funds put together, presentations for their boards on, is there an opportunity in debt? So that's, that'll benefit people who are out there trying to raise money right now.
Even for fixed income investors, bond managers, and so on that invest in CMBS, I mean, they're going to start looking at the types of returns and yields that you can get on AAAs or AAs or single A's investment grades, CMBS or CRE CLOs. And it would not, surprise us at all. I think a lot of our macro strategists think that there could be some rotation, from equity into credit that'll help drive the capital markets a little bit better.
And from a hiring perspective, are you guys expanding your teams, contracting your teams?
We're just firing the people that aren't coming in the office.
That's a good one.
Bonuses are optional, and it's bonus time, right?
We're big believers in a pyramid, so we continue to have a summer internship program and hire out of school and promote within. I mean, we do some lateral hiring, but it's probably slowed down. I would say we're more, hiring at the junior ranks and letting people continue to grow.
Yeah, I would say we're in the same boat.
Yeah, and as a diversified lender, capital markets, balance sheet, special sits, would echo what the other panelists have said.
Yeah, we stepped up this year. I think we'll probably be flat, maybe a little up next year.
Yeah, I think we staffed up pretty significantly in the first half of the year, so I would expect us to be flat here.
Well, we have a couple minutes left. These are really comfortable chairs, so none of us want to really leave. But we have a whole bunch of students in the audience. So you guys have any advice for the students in the audience? We'll start with Andrea. Sorry to put you on the spot.
No, that's fine. What I would say is this is probably the best time to be learning about real estate when we're in a downturn, right? Like, I don't want to date myself, but I started getting involved in real estate lending in, the late 80s, early 90s when we were in a downturn. And, getting involved in restructurings and workouts and kind of cutting your teeth now when it's not easy will absolutely, it'll be harder. Look, it'll be harder to get jobs, it'll be harder. But once you're in a place, you will learn so much more and you will have so much more experience because borrowers will now want to and need to engage with you to get their transactions done. So there's a lot of opportunity, in this more difficult time.
Yeah, I think we just depressed the whole audience by saying we're not hiring.
Sorry.
But I look to your point. I think Scott, you mentioned it before. When I first started, the first thing I would do was go to an Excel sheet and cell A1. I would name LIBOR and I type in 6%, right? And the kids that work for me, like, they have no idea what that means. And actually it was Lotus because it was even before Excel. But I think working through, I've had the same experience you did, working through workouts and seeing how people, how projects, how they underwrite when things, you don't have a total tailwind to your back, really helps you understand and define and look for credit issues ahead of time, really kind of retroactively. So I think this is a great market to be in. I think you're going to see a lot of distress, preferred equity, changes of use, all the things that make real estate interesting and give certain people edge. I think you're going to find in this market, and I think it's going to be an exciting time.
Yeah, I would say a couple of things, and I don't know where this quote came from, but know what you don't know. So, really invest in yourself. Real estate's a large industry. There's a lot of different property types and markets, and the capital markets are always moving. But be aware of where you need to kind of improve your own skills and continue to work on that. And then the other thing I would say, and it's a little bit of perspective because I'm involved in a promotion process within the bank where we look at candidates that are up for promotion. And one theme that we see is just those candidates that will quote unquote call for the ball. People that are willing to take some initiative, some leadership. It's not just about intellect, being able to execute your job well, and a person that has good integrity. Because if you're part of that promotion process, you probably possess all of that. But who's really calling for the ball? So I just leave that with people as something to think about.
Yeah, and maybe another gloss on that. Thinking about having an open mind, being creative, being willing to do the job that is needed at the time. So you may have 2 years ago thought your job was going to be one thing, might be a slightly different thing in this environment, but having an open mind and realizing that there are tremendous learning experiences, even if the job description or what you thought you were going to be doing every day is different. I worked at Lehman Brothers, and my sort of 2008 to 2012 experience was very different than what I expected it to be, but tremendously valuable and interesting and a great learning experience. And you just have to say yes to opportunities when they come up, even if they're not the ones that were sort of on your 5-year plan when you made it 3 years ago.
I would say real estate, more than many other industries, is really a people business. So I think for all those young people who think it's okay to text or email, actually meeting people or at a minimum picking up the phone is critical. I would also say make as many connections as you can. Obviously, being in school, that starts your network. My first job was actually at Lehman. It wasn't actually one of the original jobs I applied to. It was before the internet. I went through another job interview, actually at a firm called DLJ that also no longer exists. They said, we're not hiring, but I think the folks at Lehman are. Why don't you go over and meet them? So you never know what's going to happen. And also just those contacts and connections are critical. And also Chris's point, if you are lucky enough to have a job, go to the office. People want to see you. That's where you meet and learn. And there's no substitute for that in-person contact.
The people you're working with are more important than the job in a lot of cases. You got to look at the job, but are the people that you're going to be working with or for there to help you to progress your career, to teach you? Because the early part of your career is the most important. 5 years in, you can start worrying about money, but the first 5 years, develop your relationships, develop your skills, work with people that are going to invest in you and that are in the office. Because you're going to, if you going to the office and hanging out with a bunch of young people that don't have experience isn't going to help you. So make sure that the people you're going to work for are in the office as well. I think it's critically important.
And they want to teach you. I always tell people, do not take the first job that offers you the most money. It was amazing to me that people, again, I'm dating myself, but different firms maybe paid an analyst or an associate 5 or 10 grand different back in the day, and people would choose that over, or did you meet with the people? Are they going to teach you? Do they actually invest in you? Do they have a program where you can stay after a few years, or are you just kind of cheap labor where they're going to send you out? I remember hiring someone from an investment bank I won't name. The kid had never left the desk after 2 years. He was in a real estate group and never once left the office to go visit real estate, which has shocked me. One, he wasn't obviously learning, but he also wasn't making those connections. So I think it's really important to understand, how do they view you. Our perspective is people are pretty much negative leverage for the first 6 months to a year, and we have to invest the time and effort into them to make them worthwhile. And then once we are at that point, we want to keep them. But you have to have a job that they look at you that way.
Great advice. Well, there you have it. I'd like to, it's been my absolute privilege to have this esteemed group of panelists, and just want to thank everyone and thank the panelists.